You're listening to the Economics and Country Risk podcast from S&P Global Market Intelligence. In each episode, our experts will provide you with the where, how, and when to make decisions that transform your business.
In mid-March, about a month ago, we began seeing growing concerns in the financial sector. Several banks found themselves in trouble and then quickly went under, starting with Silicon Valley, then Signature Bank, then First Republic, and finally Credit Suisse. The downturn in these banks gave rise to worries that we could be looking at another financial crisis along the lines of 2008. And while today it appears that we have avoided the worst, there still exist broad questions regarding the stability of the financial sector. We're going to discuss why these banks failed, the differences between this current situation and 2008, and the implications that these failures could have on the wider economy. To do so, I'm joined by a wide array of esteemed S&P Global economists, and they include Ken Wattret, Head of European Analysis and Insights, Aries Poon, Head of APAC Analysis and Insight, Alyssa Grzelak, Director, Banking Risk, Chris Vivares, Vice President and Co-Head of U.S. Economics. Let's go ahead and start the discussion now, and maybe we'll start with Alyssa. Alyssa, we've heard quite a bit about these banks. We've seen the headlines, we've read some of the stories, but tell us a little about how did these things happen? Obviously, each bank's going to be different, but when you're looking at them, give us a little bit of backstory of how these events unfolded.
Certainly in the United States, with SVB's failure on March 10th, Signature Bank's failure 2 days later on March 12th, there were concerns about, were we going to see a domino of bank failures, or were these problems concentrated amongst these two banks? I think it's important to note that SVB had about $200 billion in assets when it failed. Signature Bank had about $100 billion in assets when they failed. Those are huge numbers, but that only accounts for slightly more than 1% of the US banking sector assets. So relative to the size of the overall banking sector, it's fairly small. They both had fairly unique business models in that they had concentrated exposure to sectors that have really been impacted by the rise in interest rates. SVB, very heavily concentrated in the tech sector. Signature Bank, very heavily concentrated in crypto. They both had an elevated proportion of uninsured deposits. At SVB, it was about 93%, which made them more vulnerable to a sudden outflow of deposits when concerns were raised about the viability of those banks. And they also had a large amount of assets tied up in long-term securities. Their failures did trigger strain amongst other small and medium-sized lenders, but we did see very strong and rapid policy response amongst authorities in the United States, with the Treasury Secretary voicing support for uninsured depositors at small and medium-sized banks, and most importantly, the Fed releasing their new bank term funding program, which allows U.S. banks to access liquidity from the Federal Reserve using the face value of their bonds rather than the market value, which opened up a huge amount of liquidity for other banks, circumventing the types of problems that we saw at SVB.
It's interesting that you bring it up, because obviously when we think about systemic risk, when you looked at equity markets, they were taking this very, very seriously. And again, it is interesting, a month from these initial occurrences, that people realize now that it's a bit more contained, but at the time it was quite a bit of concern. One bank that was a considerable concern that you didn't have a chance to mention is Credit Suisse. Obviously a different example there, but maybe you could spend just a minute talking about that.
So of the three banks that have failed on from the initial SVB failure, Credit Suisse by far was the most significant. So it was a global, systemically significant bank, about $900 billion in assets. But it's also important to note that Credit Suisse's problems are longstanding and well-known. So that bank had been in the midst of a turnaround plan and had been generating losses for some time. And I think it did get caught up in the general market uncertainty and unease following the SVB and Signature Bank failure. But the way the Swiss authorities engineered the takeover by UBS, preventing the disorderly failure of Credit Suisse, was successful in reducing further strain within the European banking sector.
And then finally, it does seem as though this is somewhat different than what we saw in 2008. That was mortgage-backed securities, and everything we thought about subprime. But any parallels here, or are they really different types of events?
Anytime you have interest rates rising, you're going to see strain emerge within banking sectors. But it's important to note that banking sectors are much better positioned now than they were heading into the global financial crisis in 2008, 2009. Banks are much better capitalized. Credit growth has been much more measured, and regulatory changes and supervisory enhancements that have been made since 2008 have really gone a long way to increase the resilience of the global financial sector. Not all credit booms lead to a banking crisis, but it's fairly rare for a banking crisis to occur without a preceding credit boom. And we've seen credit growth that's much more measured over the last 5-6 years than was the case heading into the global financial crisis in 2008. A key differentiator is that the problems that we've seen at SVB, Signature, and Credit Suisse were really liquidity-driven strains, not credit risk events. Unlike in 2008, where you had a vicious cycle within the US banking sector spread to Europe, with banks seeing housing prices fall, cutting back on lending to houses, their investments in mortgage-backed securities losing value. You had a vicious cycle on the credit side that really amplified risks and increased costs to the banking sector. At SVB, they did take heavy losses on their bond portfolio before their failure, but those bonds are performing as expected in the market. So it's very different from 2008, where you had huge asset quality problems and concerns. That's not what we're seeing at this point. Non-performing loans globally in most banking sectors are well below where they were ahead of the pandemic. And in general, bank lending has been much more conservative, and banks have a much bigger cushion to withstand losses now than they did heading into 2008.
Thank you. Appreciate that. Chris, you just heard there that this situation is very different from what we heard or what we saw in 2008. What are you seeing for the United States? I mean, any type of impacts here that we should be really most concerned with? And if they are, what are they?
Well, for sure, this began as a liquidity event. The initial problems were largely idiosyncratic, but of course, there were potentially important spillovers. And as confidence eroded really in a matter of days, it was clear that a run or a widespread withdrawal of deposits was possible within the banking system. And so that led the Fed and the FDIC to step in and stop the bleeding. And as a result of that now, I think it's fair to say we have an implicit guarantee of deposits above the FDIC deposit insurance cap of $250,000. I'm sure some would recoil at that notion. That has gone a long way to stop the bleeding. Nevertheless, confidence can be fickle, and there are quite possibly other shoes to fall.
So the idea is that I guess it was 100K, now 250, and then now at this point, it looks as though from the FDIC, it's pretty much anything at this point. So in this type of situation, this is almost a normative question. Is this something that could actually be creating an adverse situation ahead if everyone feels that their deposits are completely safe when it comes to these banks?
Views are kind of all over the map on this. Tom Hainig, former president of Kansas City Fed, has argued that you lose that market discipline if you don't have deposits subject to being lost or having a haircut as a result of a bank failure. An opposing view would be, well, we've got shareholders in banks and we've got bond holders in banks who are there to enforce that market discipline, and why should we expose depositors to that? And there are proposals all over the map to raise the limit for deposit insurance, require some fees to be paid for that insurance.
Can I just jump in there for 1 second?
Sure,
Something to add to what Chris just said. The moral hazard issue with extending deposit insurance, the negative effects of that is something that's going to take longer to materialize. When you're in the midst of a liquidity-driven crisis of confidence, extending deposit insurance temporarily, whether it's explicit or implicit, and we saw this during 2008 when deposit insurance limits were raised, can go a long way to stemming that crisis in confidence. So although there are reasons why deposit insurance limits exist and that moral hazard dilemma that Chris mentioned, That would really be if it was a longer term implicit guarantee on all deposits temporarily. You're not going to have those negative effects of unhealthy banks increasing interest rates, attracting deposits from healthy players within the sector, and increasing risk in that way. Those types of issues take longer to materialize.
And that brings up a good question here. Maybe this goes back to Chris to a degree. Do we think this affects bank lending, or are they likely to go to more risky sectors due to the fact that they realize that they have a federal backing there? Or have we seen anything in regards to that in just over the last month? Have we seen changes when it comes to bank lending?
Before I get to that, I just want to say we've had ongoing deposit outflows since the Fed started raising rates, and depositors have been chasing higher yields at money market funds. So this is something that typically happens during a monetary policy tightening phase. So that in and of itself is not unusual. Some banks are typically slow in raising deposit rates to defend the deposit base. Others are more aggressive. But this is not unusual for this point of the cycle. What was unusual, of course, was the very large deposit outflow that we saw at small banks in the Fed data in the week following the onset of this crisis. They divide banks into the largest 25 and all but the largest 25, which they call small, which are not necessarily small. SVB was in that group. And in that first week, there was nearly a $200 billion decline in deposits at small banks, or about 3.5%, which in a week is pretty big. But since that time, those deposits have stabilized in the last 2 weeks for which we have data. And so that is certainly a good sign, and arguably helped a lot by what the Fed and the FDIC did. Now, with respect to loans and leases did fall at small banks for the past week of data, about 0.4%, $35 billion. Is that a concern? Yeah, it is. But at this point, it's not that unusual. And I think the fear, what we've read a lot of articles about in the popular press, have been that in commercial real estate, especially where there were some liquidity issues, especially in the office segment because of the high vacancy rates and prices are softening. That could be an issue. Small and medium-sized banks do a lot of the CRE lending. And so to the extent they're holding these loans on their balance sheets, if the underlying properties lose value, that's definitely not good. But on the other hand, commercial real estate, it's not monolithic. Okay, some sectors are looking pretty strong. Warehousing, manufacturing space, even retail in some areas is doing quite well. So we have to be cautious about generalizations here. But if there's an area that I would certainly want to be aware of if I were an investor in a bank as opposed to a depositor, would be what is the nature of their real estate, commercial real estate portfolio.
Yeah, absolutely. I don't think you can generalize here. I mean, so much of this is really dependent upon the actual investments that we're talking about here. Thanks so much, Chris. Ken, maybe you could come in here and talk to us a little bit what's going on in Europe. I mean, obviously the generalization from the U.S., very specific to the individual banks, individual industry. As was mentioned at the top of the program, the biggest bank here, Credit Suisse. And so from that vantage point, where have we seen European banks, or maybe the fallout from the downfall of Credit Suisse? Have we seen ripple effects really throughout Europe here? And if we have, what have they been?
Hi, John. So, yeah, there are ripple effects, probably reinforcing what's already been evident. For example, if we go back to the period before we had the problems at SVB and Credit Suisse, one of the real emerging developments in Europe was that we were seeing credit conditions tightening significantly. If we look at the European Central Bank's latest bank lending survey that was published in January, credit standards tightened markedly across all types of loan. And the forward-looking parts of the survey were indicating that we'd see even tighter credit standards in the subsequent surveys, driven by the obvious things, expectations of continued increases in interest rates, challenging economic environment, increased risk aversion, and so on. Now, the news on the demand side of the survey was also worsening as interest rates were increasing, and that dovetails with the evidence that we were seeing in the hard lending data. Now, that's available up to February. It's been showing weakness in loan flows to both households and corporates. So what's interesting is we already had tightening of credit conditions and a tailing off of demand for loans before the problems we had in the US and Switzerland. So the likelihood now is that we're going to get even more of this in the data beyond March. And we get the ECB's bank lending survey for the early part of this year on the 2nd of May. It's probably going to make pretty grim reading. So we're already headed in a pretty difficult direction in terms of credit flows to the real economy, an additional downside risk to economic growth in Europe on top of many others that we've talked about in a lot of different forums recently. We're already potentially in quite a vulnerable position, and this comes on top of those existing concerns.
Did we find, in comparison, when we've seen financial crises in the past in Europe, have we found that maybe with regulators were spoken about before in reference to the United States, have we found that regulators have been able to step in here effectively when it comes to Europe, or have they somewhat taken a back seat?
Well, I think the first thing that we need to mention when we're looking back at prior crises is, you go go back to 2008-9 and 2011-12, Europe, particularly the euro area, had two crises. So it wasn't just a problem related to what we saw in the run-up to the global financial crisis. There were some underlying vulnerabilities. Think about a multifaceted crisis at the time based on a combination of imbalances and excesses that had been allowed to build up. Huge current account deficits in some countries, exceptional construction booms in some of those countries as well, lasting several years, leading to massive oversupply, speculative demand for properties facilitated by credit booms, which then subsequently dried up, ballooning public sector deficits and debt ratios. So there were two crises for a reason, because there were a lot of problems that had been allowed to build up without any correction. Now, thankfully, a lot of those problems are not evident now, and we also have an improved financial infrastructure in the euro area in a number of different respects. We've had the introduction of the single supervisory mechanism. So the ECB is now overseeing the supervision of more than 100 systemically important financial institutions. They account for about 80% of banking sector assets in the euro area. We now have a well-defined process for bank resolution under the single resolution mechanism. There wasn't one previously. There's huge divergence in how to approach these problems across countries, no coordination. We've got the European Stability Mechanism in place that can provide financial assistance to EU member states, including for bank support. So preventing these problems from becoming a multifaceted crisis, that's improved substantially in the period since 2011, 2012. But it doesn't mean that we don't still face some problems. We've seen sustained large increases in house prices across the European region. They're now correcting. In many countries, mortgages are predominantly set at variable rates, so they're highly sensitive to increases in central bank policy rates, which we think will continue. And we're seeing corporate bankruptcies also rising, implying that NPLs are likely to increase over time as well. So we've had, again, an interest rate shock, which is what Alyssa was discussing, which has significant ramifications. So the supervisory framework is much improved. The resolution framework has been established. The ability to take financial assistance is much more effective than it was in the past. But we also have a very significant interest rate shock, which is causing a lot of problems. So it's not entirely the same as the circumstances that led to prior crises, but we have a lot of vulnerabilities still that we need to monitor.
When it came to real estate, you did mention that higher prices now we're looking at higher interest rates. Oftentimes in Europe, we see variable rates, unlike what we see with the United States and Canada, oftentimes with long-term fixed loans or fixed mortgages. A real issue here is a possibility for not certainly around the subprime market that we saw in 2008, but I mean, anything there to really watch out for a wider downturn in that market or how it could end up affecting the economy of Europe going forward?
We're seeing pretty worrying data already for house prices in many parts of Europe. It's not the same across Europe, but if you look at the areas where variable rate mortgages are more common, so parts of the Baltics, some countries in the Nordic region, some in Southern Europe, then we're already seeing house prices in some of those economies falling pretty quickly. So in the data that we recently had for the fourth quarter of 2022, the fall in house prices in the euro area and the EU on aggregate, they were the biggest that we'd seen since 2008. And the declines are becoming more widespread. And of course, one of the issues here is the lags involved in this process. So we're still seeing central banks raising interest rates. Credit conditions are tightening. They're going to continue to tighten. And the full impact of this is going to take quite some time to come through. So the worry is that a vicious cycle might emerge. Credit conditions tighten, asset prices fall, banks' asset quality deteriorates, credit conditions tighten further, prices fall even further. And then you have some other effects, obviously, adverse wealth effects for the household sector, the propensity to consume goes down, difficulties for smaller businesses to access credit for day-to-day functions, and so on. So the risks here are very significant. Some of these are in our base case. We're expecting Europe economic conditions will remain quite challenging, but there are some tail risks here that we need to monitor closely because they would make a material change to the outlook.
Thanks so much, Ken. Really appreciate that. Aries, bringing you into the conversation too here. I mean, obviously, Asia, for the most part, spared during these recent bank failures. Obviously, we've had financial crises in the past, thinking back most importantly to the late 1990s. But talk us a little bit about how Asia was able to escape here, really, for the most part, unscathed. At least none of the major banks there facing a situation where they themselves were liquidated. How was that possible? What were some of the aspects or the factors involved there that limited some of the damage?
So on the banking level, we see, broadly speaking, APAC banks are more diverse when it comes to deposit base and loan portfolio. And also they have quite high loan-to-deposit ratio, meaning that the banks are actually less exposed to investment securities versus the peers in the US and Europe. And that actually remove some of the interest rate risk. And also for most of the banks in Asia, they are quite localized. And so investment actually within the country, except Japan, which I will come back to that later. And on the country level, we see because of the 1997-98 Asia financial crisis, APAC countries, especially emerging countries, have been making very conscious efforts of shoring up their current account and also foreign exchange reserve, just in case there will be any capital flight and there will be any pressure on currency depreciation, and they can intervene. At the same time, one key difference is that in APAC this time, the inflationary pressure is actually much more milder when compared to US and EU because of where they started before the Russian invasion of Ukraine is coming from quite a low base. And so the central banks in the region actually have a little bit more wiggle room to maneuver between financial risk and also inflationary pressure. One more thing about the regulations is because of the Asia financial crisis, some of the countries like Malaysia, Indonesia, the Philippines, and Thailand, they have been also building up these stringent requirements on bank, especially when it comes to foreign liabilities in the balance sheet, because that was the reason for the crisis back then. That's why APAC is insulated, we might say, in this time.
Wow, that's amazing. One thing I think a lot of folks forget about is that the inflation concerns that we've seen in North America and Europe, in Asia, obviously depends on the country, but for several of these countries, the impact was relatively limited, as you mentioned, right? And so, I mean, in fact, I'm going to bring up, you said you're going to talk about Japan now. I mean, that's a country, of course, that has experienced low inflation. In fact, it's a location where they've actually wanted to increase inflation at various points over the last few decades. Talk to us a little bit about Japan. You were going to bring it up in a second. Maybe it's a good time to bring it up now. How have the Japanese banks fared here?
So the context here in APAC is there are two interest rate trajectories. One side is mainland China continues easing plus Japan staying put. The other side is the rest of the APAC economies that are following the US to increase interest rates. So for Japan, they have their own concerns, but the biggest issue here is Japanese banks have been for decades looking for higher returns from investing in all these different bonds and outside of Japan because of the ultra low interest rate domestically. Japan is the biggest country holding US treasuries. And so even if the domestic rates didn't change, the investment portfolio is subject to the rising US rates. But we do not see a systemic impact on Japanese banks. We do see earnings impact because of the mark-to-market losses. One differentiator is the Japanese banks are flush with cash, whether they are big or small. So I think that is the major differentiator in terms of the buffers when it comes to the hit from rising US interest rates.
Okay. And then lastly, if we're going to be making our circle, can you mention just a little bit about what your views are on South Korea?
Yeah, I think when we talk about South Korea, people still remember in the fourth quarter last year, that was when there was a crunch in the bond market because of the builder of the Legoland missed the bond payment. And that led to a spike in the short-term yields. And there was a short period where the companies find it very difficult to refinance. I think we saw two things. One is the government there has been very proactive in terms of making sure there is enough liquidity in the market. And there were so many administrative measures just to make sure there is enough liquidity in the market. And the political willingness is one of the reasons behind why the market is recovering after that. But having said that, that was on the corporate side. On the banking side, we don't expect there will be a liquidity event per se, but we would like to watch, because when we look at the liquidity coverage ratios of the South Korean banks, they're actually relatively low relative to many other banks. Like out of the 7 biggest banks in South Korea, 3 of them actually have the LCR below 100%. So I think this is something to watch for as well. But going back to the Legoland incident, what happens is we do see the rippling effect in terms of a tightening of lending, especially to the construction companies and also to project financing. So this is something that we'll be looking at as well.
Thanks a lot, Aries. Really appreciate that. Alyssa, maybe bringing you back in here, you've studied quite a bit, looking at emerging markets. These banks, for the most part, concentrated in the U.S., in Europe. Of course, Credit Suisse would have impact in emerging markets as well. Have you seen any impact in financial institutions in other locations around the world?
Yeah, so like Aries just mentioned, for Asia, if we're looking at emerging markets more broadly, the direct impact from SVB, Signature Bank, and even Credit Suisse is minimal to non-existent. And given the way that Credit Suisse was taken over by UBS, the engineered takeover, Credit Suisse's operations are continuing. So direct impact, almost none, but there could be spillover effects on emerging markets. We have seen some tightening in terms of investor perception toward emerging markets, but it's not a one-size-fits-all response.
Okay, yeah, that makes sense. And so somewhat limited there. One thing I've been considering here, we're seeing a pretty dramatic increase in interest rates. And when we think about different economies around the world, one thing that has led to significant stress when we think of sovereign risk or sovereign debt risk has been rising U.S. interest rates. And certainly we've seen that in Latin America in the past, we've seen it in Asia. Any sense here that going from what practically 0 to 4.5% plus, is this having a dramatic impact on various countries around the world? And if they are, which are the ones that we've been looking out for?
Anytime you see interest rates rise after a period of low interest rates, and what we have seen is ultra low interest rates for a very prolonged period, and now a very rapid rise in interest rates, you're going to have problems materialize. There's a few countries within the emerging and frontier market bucket that have already been seeing bond yields rise above kind of the psychological threshold of 10% that starts to call into question the sustainability of debt servicing. The worst affected emerging markets so far have been Kenya, Nigeria, Egypt, Ecuador. Some smaller frontier markets with high debt are certainly worse off. But then you've also seen countries like Panama, Costa Rica, Bahrain, and Turkey successfully raising debt since mid-March. The thing that I want to emphasize, like Chris mentioned earlier, about not generalizing within the commercial real estate bucket, we shouldn't generalize within emerging markets either, and investors aren't. There's been a two-tiered picture that's emerging with higher debt, less sustainable countries seeing yields rise, problems accessing capital markets, well-managed, lower debt emerging markets continue to access capital markets with high demand.
You're going to have winners and losers here, and the ones that are prepared for this type of eventuality are likely to do far better than those that didn't. Maybe switching on that line of thought, Chris, bringing you back in here. Well, we just heard higher interest rates going to cause problems for various folks really around the world. When we're looking ahead and you guys are doing your forecast here, are we seeing increased rate increases here as we're starting to continue to focus in on inflation? The headline number 5% is somewhat moderated, but that's still well above 2% or 3%. Does this mean at this point, because of the banking troubles and because of lower inflation, we're going to start seeing a pause in these rate increases, or we still have a few more left that we're going to have to endure?
So let me distinguish between policy rates and market rates. So policy rate, the answer is yes, and I'll get to why in a second. On market rates, we've already seen a significant pullback. So the 2-year Treasury yield has fallen about 100 basis points from its peak pre-SVB failure. The 10-year Treasury note yield has fallen 60, 70 basis points since pre-SVB failure. So market rates are down a lot, and that certainly plays a role in terms of pressuring economies outside the U.S. with potential capital outflows. With respect to the policy rate, it's certainly possible that this will lead to lower rates. So to the extent that banks are pulling back on credit extension, that is a tightening of financial conditions. And further, to the degree that pullback slows spending growth and softens demand, that can substitute for additional Fed rate hikes. We have put that into our forecast. We took out the expected tightening that we had in June that would go from 525 to 550 range. We still have the tightening in May, that 25 basis points to get to 5 to 525 range for the Fed funds target. But markets also are anticipating, and I should say markets agree at this point, based on Fed fund futures, that there will be a 25 basis point tightening in May. However, it looks like June, not so sure whether the Fed might reverse, probably hold steady, but very clearly signaling an expectation that policy reversals could come as early as July. Seems a little early to us, but that's what's in the market. So yeah, it's certainly possible that we'll see lower rates than we had expected previously.
I know you keep a crystal ball in your desk there. I won't tell you to get it out at this moment, but looking a year ahead, if you had to say if rates do start to ease a bit, how far down could we go?
That partly depends on how high we go. And right now we're balancing the degree of pullback in credit through the credit channel as a result of the banking crisis as against further Fed rate hikes. So if we don't get much of an impact through the credit channel, the Fed could go to 525, 550. They might even go 550 to 575, in which case they may hold that for a period of time. And a year from now, could they be 100 basis points lower if the economy, in fact, starts behaving and inflation comes down? Yeah. That's as specific as I'm going to get on that hypothetical.
That's fine. That's fine. Appreciate that, Chris. Ken, looking ahead, we've seen the ECB, we've seen several European central banks increasing rates. Again, primary concern there being inflation. Lots of headwinds here, whether it's the war or whether it's the real estate market. Are we going to start seeing really these hikes begin to taper off? It also potentially start to decline as we start to look ahead.
Good question. Taper off, yes, in the sense that when the ECB first started raising rates, for example, it was doing 75 basis points per meeting. Then it moderated to 50 basis points per meeting. This is an unprecedented tightening cycle in terms of the speed of the rate rises. They're not going to continue at that order of magnitude indefinitely. But I think something to bear in mind is that there was a period in 2021, early 2022, when the ECB was still of the view that inflation was probably picking up in a transitory fashion. So they started the tightening cycle relatively late. And the level of policy rates in the euro area has picked up very quickly, but it's still probably not as restrictive as the ECB thinks it needs to be in order to bring inflation down. And just to comment on inflation, headline inflation in the euro area has been falling in recent months, but it's entirely due to energy effects, partly because energy prices have fallen, partly base effects because of what was happening around the period of Russia's invasion of Ukraine in early 2022. If you take the energy price dynamic out of the calculation, inflation in the euro area, excluding energy, is running at almost 8%. Pre-pandemic, the trend was about 1%, and the ECB has an inflation target of 2%. And in its projections for the subsequent 1, 2, and 3 years, it's not expecting that inflation will get back to its target rate. So the clear inference from that is that they have further to go. We saw in mid-March, in the thick of all the problems with SVB, worries about Credit Suisse and so on, the ECB delivered another round of 50 basis point rate rises, and all the central banks that shadow the ECB pretty much followed suit, right? So that is clearly telling us that inflation remains the primary concern as long as the banking sector problems remain idiosyncratic and are not threatening to become systemic. So the way I would look at this is there's a trade-off here. One way or another, financial conditions are going to tighten because that's the intention, is to slow economic growth below potential, to create some slack to bring underlying inflation pressures down. If it comes through the credit channel and there's some signs that that's happening, then it means policy rates will not have to go up as far. If those credit headwinds diminish, then the peak for policy rates could be higher. It's interesting to see how market expectations have evolved. In mid-March, basically futures markets priced out any more interest rate rises from the ECB beyond March's meeting. They're now back in to back-to-back increases at the May and June meetings, the next two meetings. We think that makes sense because the balance currently is still tilted towards them leaning down on inflation, and particularly underlying inflation. Headline inflation matters, but those drivers of underlying inflation are still a concern, particularly wage growth and potential stickiness of services inflation. In thinking about monetary policy pivots, how quickly we move from rate hikes to rate cuts, we did some work on this recently. It varies depending on the circumstances that have driven the tightening cycle. Typically, on average, over the last couple of decades or so, those pivots have been less than a year. But those pivots are much shorter when there are financial stresses. But of course, the consequence of those financial stresses is very negative for economic growth. So we need to be quite careful as to how we interpret the lengths of those policy pivots. Shorter gap between the final rate hikes and the initial rate cuts is not necessarily a good thing for economic prospects. And maybe just briefly to mention for Europe, it's not all about what the ECB does. We don't have a uniform outlook for monetary policy in the whole of the European region. In some parts of emerging Europe, central banks are already lowering their policy rates. They're generally the ones that push them into double-digit levels because they had genuine worries about inflation and inflation expectations, and they're cutting in response to signs of economic and financial distress. So again, the individual circumstances here really matter in terms of monetary policy prospects and in turn, economic conditions.
Chris, any response to that?
In the U.S., we had exactly the opposite market response. In March, ahead of the SVB failure, markets were pricing in additional Fed rate hikes, and that seemed to be moving towards higher and higher peak rates. Subsequent to the crisis, that's all gone away with a lower peak and an earlier reversal.
Yeah, thanks, Chris. Ken, we have so many things happening at once. What are the growth forecasts right now for Europe?
I don't want to sound too downbeat because we've seen in the last few months that some of the leading indicators, including our own proprietary data, the PMIs, have been improving. It looks as if Europe in general, thinking about the euro area and the EU, have avoided winter recessions, although it was a pretty close call from what we know about Q4 and what we know about the early part of Q1. And I think what's happening is there's a bit of a relief bounce going on because those worries about energy supply, potential energy shortages, and potentially severe downturns in activity over the winter were avoided. There's also a bit of a pent-up demand effect still, I think, from the service sector, where the recoveries in Europe have been a bit slower than in other parts of the world. So there's a lot of crosswinds blowing here. Bottom line is, for a sustained improvement in growth prospects, we really need inflationary pressures to diminish, to ease that squeeze on household real incomes, and to shift financial conditions from tightening into easing. And I think that's going to take some time. So although the immediate economic environment in Europe looks a bit better than we thought it probably would from a few months ago, we need to be cautious.
Aries, looking at monetary policy inside Asia, it looks like some central banks have seen some pauses in rate hikes recently. Do you expect those to continue? And which are the ones you're watching out for mostly in respect for, either reversals or continued rate hike?
Yeah, there are more reasons for APAC central banks to be more cautious in tightening, let me put it that way. And we do think some of the economies might be near the end of the tightening cycle. In the past few weeks, we've seen some pauses of tightening in Australia, in Indonesia, in India. In fact, Australia central bank actually said, because, it wants to watch out to make sure that there is because of the banking instability and the impact is not going to have this ripple effect into the economy. So they want to just wait and see. But again, it's also not uniform because in places like the Philippines, where the inflation rate has hit a 14-year high, they actually continue tightening. So I guess it all comes down to where your inflation is, because the central banks here in APAC can afford to pause because we've already seen rising interest rates have had impact, especially on leveraged borrowers. And we've seen for example, in Australia, in New Zealand, in South Korea, where the property markets have slowed down quite noticeably because of the mortgage rates and all that. But so far, it's still not really a systemic problem per se, but it is a growing concern of macroeconomic vulnerabilities.
And that's all the time that we have. I want to say thank you to all the panelists. Really good information that they provided to us today.
Thank you for listening to the Economics and Country Risk podcast. Connect with us on LinkedIn and Twitter. And don't forget to subscribe to the podcast so you never miss an episode.